We continue with our discussion on advanced financial modeling and building a good valuation model or a company model that links the financial statements of the companies. And in the same context, we have now created a completely dynamic model with a broader schedule around the debt funding of the company as well, and what kind of debt requirements the company might have. We will now move ahead and start incorporating, from the perspective of our understanding of a fully functional model, the ratios of the company. So what kind of ratios are we going to look at? What kind of ratios the company is showing us when we are looking at this data? And how do we calculate those ratios as we go along, right? So the ratios bit we have already learned earlier as to what the ratios are. For our benefit, we have just listed down the basic ratio name and the formula for that ratio. And we can now go and back calculate this data and identify what is going to be the ratio for this particular company in each of the years, right? We need to do that for 1 year, and then once we do it for 1 year, we can just drag it and move it in terms of the rest of the years, right? So FY11 onwards, we are going to calculate first the profitability ratios, which are operating profit margin, EBIT margin, net margin. Second, the return ratios, which are return on equity and return on capital employed. Coverage ratios, which are interest coverage and debt equity ratio. Solvency or liquidity ratios, which are current ratio and quick ratio. And then turnover ratios, which are basically efficiency kind of ratios, right? So let's start with the profitability ratios. Operating profit margin or EBITDA margin is nothing but earnings before interest, tax, depreciation and amortization divided by the net sales. On our P&L, both these numbers are available. So when we look at the P&L, we have EBITDA available here, and we can divide it by the net sales number, right? Or the total operating revenue number, and we should get the number here, right? If you look at the calculation of EBITDA, there's a small calculation done here itself, right? This divides B24 by B8, which is only the net sales number. We have divided it in our formula by total operating revenue, which is the sum of these two, right? So that's the minor difference that we are looking at. We need to convert this to percentages and put it here. Similarly, EBIT is also available there. So I can go to my profit and loss account and look at what is the EBIT that's available here and divide it by the total operating revenue number, and we get a number there. And similarly, my final net profit number is available on the P&L. So I can go to the P&L, look at the net profit number and divide that by the total operating revenue number. We can use total operating revenue, we can use net sales. Since we've written net sales here, we can go ahead and change all these to net sales. Otherwise, if you want, you can write total operating revenue here as well, right? So instead of net sales, I can write total operating revenue in all of these formulae and just copy this and paste that here and paste that here, and we get our formulae. We get our formulae when we convert it to percentages. Just add a decimal point, and let's try and drag it and see what happens in the first 4 years. So we find that there is a remarkable steadiness that the firm has shown in the first 4 years of its numbers. And if I continue putting those numbers, remember the last 3 years are assumptions that we have seen. The first 5 years are data which is available to us. So as a good practice, what might be done is we can try and shade the numbers which are essentially historical and shade the numbers which are projections separately, right? So historical numbers, let's shade them in this color, and future numbers, let's shade them separately in maybe another color, right? So it's a good idea that we can immediately spot which is history and which is future, and what's coming from our projections and what the company has shown. So the company does show an increasing trend in operating margins in the past, basically either because of better product mix or because of higher per average car price or whatever data we want to look at, right? Let's move ahead and calculate return on equity. Return ratios. Return ratios, if we remember, are ratios that are essentially telling us how much money the company is generating on the money people have invested in it. The shareholders have invested share capital plus reserves and surplus. The debt guys have invested long-term loans, right? So the return on equity is calculated as net profit divided by, on my balance sheet, the sum of, in fact, that's available as a sum, so I don't need that. I can just delete this and just put the total shareholder funds here, right? And that's my return on equity. Return on capital employed will require a summation. So EBIT is on the P&L. Once again, I click on EBIT here and divided by the sum of shareholder funds plus long-term debt, long-term borrowings, right? And we calculate that. So that's my return on capital employed. The percentages can be looked at it again. I can drag it here and I can copy this. If I drag it on the right side, it will essentially change the color. So I can copy the formulas on the right side and I can copy the formats on the right side, right? Sorry. The moment we copy the format, it is going to change things. So I'm going to convert it manually to percentages, right? That's the calculation. As per our assumptions, return on equity and return on capital employed will decline based on the projections we have done. Remember, our idea was not really to debate what numbers went in at this point of time in this model. We were just building a dynamic functional model. The actual inputs have to be debated in real life. And that's something that we will cover under the valuation aspect of things in another subject. Here, we are primarily bothered about, is the model linked correctly or not, right? So historically, the company saw a big decline in return on equity and then again a jump, and decline in return on capital employed as well, and then a jump that the company saw, and that's captured in the return ratios. EBIT divided by the interest is going to give me the coverage ratio now, right? So these are numbers available on the P&L. EBIT divided by the interest or the finance cost, and that's my coverage ratio. And similarly, my debt equity ratio is my total debt. Now, total debt is long-term debt plus short-term debt. So I can go to the balance sheet and add long-term borrowings plus the short-term borrowings and divided by the total shareholder funds, which is here. So that's my debt equity number and negligible as we saw, right? So practically zero debt firm that we see here. We can drag it on the right side till these years, and then we will eventually change the color of these three separately. We'll again change the color here, right? So we see interest coverage has been fairly comfortable for the firm and debt equity has been negligible. Based on our projections, we had, however, assumed the company's debt to go up. So if I add a decimal point, you will see debt equity rising and consequently interest coverage going down because the interest number will go up, right? Those are our projections as per the projections we have done so far. Those are our coverage ratios or debt equity ratios. Solvency or liquidity ratios tell us whether a company is able to repay the current liabilities that it has, right? Whether a company is able to kind of quickly offload the current liabilities using its current assets. So that's a straightforward number. On the balance sheet, we go and just divide the total current assets of the company, that's here, by the current liabilities of the company, that's here. So total current assets by current liabilities, this is the number. And when you look at the quick ratio, we remove inventories from current assets typically. A more stringent format is just cash plus receivables, right? So if we look at cash plus receivables, on the balance sheet, what all is cash, right? So this is cash and bank balances. That's one. Current investments, remember, is also kind of cash. It's basically invested in instruments that will mature within a year, but it is equivalent to cash. And to this you add trade receivables, right? Close bracket and divide this by the current liabilities. So even this number is a fairly healthy number as per textbook definitions of current ratio and quick ratio. Typically, higher the number, better your chances of meeting your short-term obligations. Though we have discussed earlier in AFSA that sometimes this may not work, and companies with lower current ratios, like what we see towards the end, may still do well. Why? Because they have kind of successfully moved towards a negative working capital scenario, right? And Maruti seems to be doing that in the years as we lead up from the current ratio going up from 2 to zero point 0.9 and quick ratio going from 1.8 to 0.46, right? So they've basically started using the cash, it seems. So when we look at the cash numbers here, uh, the current investments number suddenly went down in the previous year because they probably used it up in capex, and that resulted in the decline in the total current assets, and that would have resulted in the decline in the current ratio and quick ratio. They must have done some capital expenditure in the previous year, and that's why the cash numbers went down. And what we see here is actually that they have basically used this cash. It's interesting to look at some of these ratios because it brings us to the question as to why is this happening, right? Now, when you try and answer this why, you see current investments go down, you see cash goes down, but you don't see fixed assets going up. You, on the contrary, see non-current investments going up from 1300 to 9817. Now, you may want to find out what was this non-current investment that happened, right? At least when we look at these ratio kind of numbers, it brings us to a point where we identify, okay, what is the change that we are seeing in the particular number and why is that change happening, right? So that's the benefit of creating a ratio sheet and looking at trends here. Finally, we come to turnover ratios, which are essentially your efficiency ratios. All turnover ratios are sales divided by the respective turnover ratios. So we can look at net sales on the P&L, and because we've calculated data on total operating revenue, I'm going to use operating revenue divided by inventory in the first case. This is receivables turnover ratio, which is going to be my total operating revenue divided by my receivables in the next one. Then total asset turnover ratio is my total operating revenue divided by my total assets on the balance sheet. And fixed asset turnover ratio is my sales operating revenue divided by the amount of fixed asset that the company has. So total fixed assets here that we see, right? And based on these, we get our numbers. We can drag it in the future, right? We can just give me a second. Yeah, so that's what we have dragged, and we can select the final three and recolor them, and we can select all of these and possibly remove a decimal point, right? Now we can again get trends here in terms of seeing that total asset turnover ratio is going down, fixed asset turnover ratio is going down, which basically means that fixed assets are increasing and sales are not keeping pace with that over this period, right? We will note that fixed assets have doubled, which means the company has put up significant capacity, right? 6,300 going up to 13,000, the company has put up significant capacity. But when we look at the assumption sheet, does that match? It has put up significant capacity. Capacity has gone up. But the selling numbers, they used to sell 12 lakh 71,000 cars here. They're still selling about 12 lakh 92,000 cars here. So the sales number has not changed dramatically. The sales has not gone up in that proportion essentially. Per car number has gone up. So 36,000 crore became about 50,000 crore or 49,000 crore. But the sales have increased by about 40%, but fixed asset has gone up by about 100%, right? So the company seems to be sitting on idle capacity, but not using it. That's evident from a falling fixed asset turnover ratio, right? And similarly, you look at receivables turnover, fairly steady. In between a couple of years, you saw receivables jumping up a little bit, but again went down in the last year. Inventory turnover ratio is also kind of stable at around 19, 20 to 25 times. The company turns inventory about 20 times during the year. right? Which basically means they keep inventory worth about 15 to 18 days at any given point of time, right? That's basically the ratio numbers. We can look at projections. We can look at projections and try and understand if those projections make sense. We have assumed that the company is going to add a lot of capacity. We have assumed that the company is going to probably look at higher current assets because of increasing cash. Over a period, the company's profitability margins seem to be going up because of the assumptions we have made. We can look at these trends and try and decide whether it makes sense in terms of what assumptions we have put in, right? That's the benefit of putting some of these numbers here. That's the benefit of looking at some of these data points. We can extend this analysis if you want to create charts out of this by selecting some of these data points for these years. So let's say I can select this and create a chart out of these numbers to arrive at what's happening with operating profit margins, EBIT margins, and net profit margins, right? All I need to do is select a set of data and arrive at the numbers. And instead of these, I can change my axis or format axis to include the data, right? So the select data for this. On the axis, I can just edit the axis labels and put those labels here, right? So these are the labels I'm looking at, and we can click on OK and click on OK, and we see FY 11-12 coming in. So basically we can plot all of these on charts, create interesting charts out of the ratios based on what we see is happening with the company, and then present this as a report when we are doing that, right? That's about the ratios that we are looking at. That's about how we calculate ratios in a fully functional linked financial model. Thank you.